world as well. But speaking about growth, let's talk about SBFC Finance. That's the first management on the show. Reported a good set of numbers, a 28% growth in their disbursements, or rather in their AUM. The net interest margins as well came in fairly healthy. We have Mahesh Dayani, who's the Chief Business Officer at SBFC Finance, now joining in. Thanks a lot, Mr. Dayani, for joining in. Congratulations on a good set of numbers. The question, obviously, that begets asking is that this 28% growth that we've seen in your AUM, is that sustainable? I mean, what's your AUM growth target for this year? And also on your margins, what we want to understand is, in a scenario where interest rates might be reducing going forward further, where do you intend to maintain your net interest margins?
So the first question on growth, I guess we've been guiding 5 to 7% now for probably more than 8 quarters in a row. That's obviously coming out from a low base. So we don't see that as a challenge of even sustaining for the next 4 quarters. So our guidance has always been that even for at an elevated base, we will continue to grow at 5 to 7%. So on a compounding basis, you would be in the range of anything between 25 to 30%, and we'd like to stick to that guidance as well. If you look at our last quarter numbers, the disbursements were fairly firm for both our mortgage business and our gold business. Gold business obviously did see an uptick because of the price, but even if we were to discount on the price, I think the volume growth was in the range of 15 to 16%, which means that it is a sustainable runway for the next year as well. Coming to your question on the price, what we've maintained is that our cost of borrowing continues to remain where it is. In case it comes down, that's the bonus for us that's going to come in, but we've not penciled in as yet because we feel that the transmission does come with a bit of lag. So with all our projections, we've maintained that we'll be able to maintain our spread all through the year. In case the reduction happens, that comes in as a bonus.
Mr. Dayani, good afternoon. Thank you for joining in. We are in this declining interest rate environment, right? We have already had a couple of rate cuts from the RBI as well. Now, with that happening, how does that impact your yields and your margins going forward? Because there are also more rate cuts that are on the anvil as inflation cools down. So what does that do to your yields and your NIMs?
So, if you look at our spreads have largely been constant, probably marginally upticking. If you look at the commentary's been, obviously the rate cuts are going to come in. It hasn't really translated to your MCLRs being reduced by most of the banks. I guess that's also going to come in, but it's going to come in with some bit of lag. So even if we look at a reducing interest rate scenario, most of our book is variable. We would be able to pass it on, but we'll get the benefit of it from the banking system as well. So our spreads largely are not going to be compromised or not going to be impacted even in the next 4 quarters.
Right, spreads will, stay where they are. I'm wondering about the asset quality. If you are growing at the pace at which you are, 5 to 7% every quarter, which implies about 25 to 30% annually, will that at some point hit asset quality? Just trying to understand what's the kind of asset quality targets that you have. So far, it's been maintained. It's been, in fact, improving, if anything. Net interest or rather net non-performing assets are close to 1.5%. What's your asset quality and credit cost guidance for the year?
So our credit cost guidance has largely been in the range of 1%. That could probably move 10 basis points here or there. Given the construct that you see, I think last year we had actually gone a little slow with respect to our disbursals, and that was consciously by design that we decided to move ahead. And this was largely because we did see the leverage at an individual level, at a business level moving up. And as you know, the delinquencies always come with a lag. So we've been cautious whole of last year. Our view doesn't change significantly. So we don't expect too much of volatility even in our delinquencies moving forward. And hence our guidance on the credit cost to be at the present levels of 1% doesn't change from here.
So, Mr. Dayani, do you expect this asset quality number that you reported around 2.7% for the quarter, do you expect that to trend down, or do you expect it to remain in this 2.5 to 3% range as we go along in the new financial year as well?
So I don't think it's going to come off significantly. It's going to probably be very, very range bound. One of the advantages of being into secured is that you don't see significant volatility on a quarter-on-quarter basis unless and until there's a large event unfolding. So you wouldn't see too much of volatility even in our gross NPA numbers moving forward.
Are you looking at increasing the securitized part of your book? And at the same time, if you could give us a sense on whether you'd require capital anytime soon. I see your CRAR at 36%. You're fairly comfortable, but the pace at which you're growing, maybe at some point you would require to raise capital, right?
So we're not looking at raising capital at least for the next 8 quarters. If you look at our ROEs are closer to 13.1 odd percent, 13.1 to 13.2. Our capital adequacy is 36%. We're vending out almost 95 crores of profit, which gets further supplemented to your capital. So we're fairly comfortable on the capital as yet. We would probably not get back to the market at least for the next 8 quarters.
And Mr. Dayani, your provisions too, I was just looking at your numbers, your provisions went up both on a sequential and on a year-on-year basis. Would you believe that this is a quarterly trend, or do you be proactive and you provide more just to ensure that there is no further slip up?
So we feel that, obviously if you have a fantastic season and you have provisions available, there's extra management overlay available. So you would want to really scuttle that in and provide for it. So that's the reason you see our provisions being at almost 45.5%. Now, this is the highest that we've reached in the last 8 to 10 quarters that you would see. We'd like to, keep providing for it as and when we get the opportunity. We'd like to run on a full momentum with full gas available so that if in case there's an event which happens, it really doesn't disturb our earnings outcome in any way.
All right, so spreads above 8% around current levels, NIMs above 10% around current levels, growth between 25 to 30%. We're looking at asset quality maintained at current levels with credit costs being sub 1%. We have all those numbers. And since the mood is such, you're giving us a bunch of numbers as well. If you could give us a couple of more numbers as well. One is on the cost to income ratio. It's currently sub 40%, 39.7% in this quarter. And the securitized book that we, did speak about, you missed giving that answer. Currently about 1250 crores. How much of your overall book do you intend to securitize going forward?
So one is, that's not a securitized book. So what it comes is largely is in the form of co-origination that we do. So where 20% is with us and 80% is with the co-originating partner. So in the overall AUM, it just comes in, but that's not a securitized book. So probably that answers your question on the securitized.
And cost to income?
So cost to income, we've always been guiding that as our distribution sweats, we've guided that our cost is going to come down by almost 50 basis points. Last year, it came down by almost 70 to 75 basis points. This year's guidance is that it will continue to come down by 50 basis points. So that's going to have a positive impact on our cost to income ratios, which will improve all ratios, including the ROEs moving forward as well. So if I were to actually summarize, we have a very boring outcome. It's as good as you predicting what our next quarter is going to look like or next year is going to be look like. So our guidance doesn't change. We're as predictable as boring as we can get.
Boring is good. In this market, boring predictable is incredible.
Indeed, boring is indeed good. Mr. Dayani, thank you so much for joining in, and wish you good luck for the rest of the quarters as well. There's the management there of SBFC Finance on the road ahead. By the way, the Nifty growing from strength to strength now at the highest point of the day. 24,312 is where the index stands at. 24,365 is a Friday's high that needs to cross for the first leg that needs to cross. But for now, at the highest point of the day, 275 points higher on the index. Take a short break. Up next, we'll be joined by the management of Chennai Petro. Managing Director H. Shankar joins in on the other side. Stay tuned.